So in the academic sense, I want to talk about benefits and what they are. So they're the non-wage compensation provided to employees such as group insurance, retirement benefits, daycare tuition, reimbursement, and specialized benefits. How many of you engage benefits right now? How many of you have your parents' benefits? How many of you have the Georgetown student benefit?
The student insurance.
Yeah, the student insurance. How many of you are uninsured? It's okay, you don't have to be embarrassed about it. It's okay. Everybody's insured though. So somewhere we have benefits. You either pay for them on your own, you have student benefits, or you have your parents' benefits, right? And we really don't think about benefits. Like, you know, you kind of go up through the world and you're like, wow, it's nice, I have health care. I get to go see a doctor for 20 bucks, which it really doesn't cost 20 bucks, but that's your copay. Or, you know, I wonder how people pay for daycare or how they get to have it at work or stuff like that. So it's not very interesting stuff, but it's the stuff that when an accident happens and you're uninsured, it's a problem. So health and welfare benefits are basically health insurance, dental, life, and disability. And I'm going to talk through each one of these kind of at a high level, and if you have questions, we'll go deeper on it. But the one thing that I think is most important is to realize when and what you need benefits for. So most people have preconceived notions of benefits. So I'm going to ask a few questions and ask you to tell me what you think is right. Benefits that are very costly, is that better than benefits that are low priced?
Costly to who?
To you, they cost a lot. Like if somebody says you have a plan where you can pay 40 bucks a month or you pay 90 bucks a month, what do you do?
Pay 90 bucks a month.
Why is that?
Because usually that means that you are getting better benefits.
Okay, that's not necessarily true, and that's actually where people go. 90% of the universe that I've ever worked in buys expensive benefits. So healthcare is the most expensive benefit that you'll pay for. And usually an employer, and I want to talk about why I'm talking about price, because where you are in your life spectrum, every dime counts. So how many of you are exiting this year? Are you all seniors?
And grads.
Okay. So those of you that are exiting into the workforce or already in the workforce to some degree, your most expensive benefit will be your health care. And the second to that will be your retirement benefit, we'll talk about in a minute. So healthcare is awkward because you think, I always thought this until I was a healthcare professional, it's the more you pay, the better you're getting. And that's not necessarily true because it's based on what you access healthcare for. So there are many different spectrums of healthcare. There's PPO, which is a plan provider organization, where you actually have kind of this really large freedom to go and do whatever you need to in the healthcare system, and it's covered, and you pay a little copay, and that costs a lot of money to have that freedom. Then you have a healthcare managed organization, where you actually get to go through a Kaiser model as an example, where you go to one place and they actually manage your care for you. And then there's something in between called a point of service. And a point of service is a plan that allows you to get coverage kind of within a network as you need it within this network. And if you go out of the network, you end up paying out of pocket. Why I'm talking about those different pieces is that your age going into the marketplace, and unless you have very specialized needs that have a specific network and requirement, you should get coverage that you know covers you for the most crucial incidents. So for example, being uninsured and being out on your own after being out of college and being in a job and having a $40,000 incident because you were skiing and you broke your leg and had to be hospitalized can be kind of life-changing, because we don't have $40,000. That's why you have health care. So when you're in the marketplace and getting a job and they're offering you different options, you need to look at kind of what you can afford and what makes sense for your healthcare needs. Because we have many faculty here and staff that go for our highest price plan. And our highest price plan is not necessarily the plan that serves most people. It's just the highest price plan. And the highest price plan is not always driven by the fact that it's the best service for you. Benefits are actually created based on risk pools. And so if this plan X is $150 more than every other plan and their services aren't dramatically different, it's because the people that are in that plan cost more than anybody else. So for example, when I first got to Georgetown in 2006, we had 2 health plans, which seems awkward for a place like Georgetown to only have 2 health plans. We had Kaiser and we had UHC. So 50% and 50% kind of divided based on what they could afford. And so they were dramatically different in price because Kaiser is a one-stop model and you have to use that model, and UHC allows you a lot of freedom. So over the years, I added more benefits, and what ended up happening is the amount of cost for the UHC, which was the higher cost plan, got even higher because as we added more plans, people migrated to plans that were more affordable and made sense to them. So all that blah, blah, blah I just said was for the purpose of making sure you're aware that when you're actually engaging your benefits, you don't engage them on price, you engage them on need. So this is something that's very important when you're getting your first job offer, right? So I don't know what starting salaries are today, so I'm going to throw something out there. So you're leaving Georgetown and you're starting at $60,000 a year. Is that a good salary to start at? No. Okay. So you're starting at 60 grand a year. They offer you 60 grand a year health coverage, and they're covering health coverage at like 80%. That's a very, very rich offer. Because 80% of coverage means that you're only paying that 20%. And if a plan is, $100, which they're never that low, you're paying $20, right? It's a very small amount of cost. I believe that you actually engage healthcare at the best price possible to serve your highest need, not the highest price possible to serve your highest need. So when you're actually in that job offer scenario, you're going to be offered a job, you're going to walk away, you're going to feel really good about yourself, you're going to call all your friends that you're making 60 grand a year, right? And then you're going to think about your health care. So that's a huge piece of being offered a job, is your health care. Yes. So when you're engaging in your health care, it's really important to make sure that you are actually looking at what you should be paying for, not what you feel like is the most expensive thing you could do. Because what ends up happening is you spend a lot of money for a scenario that you may see a doctor for a physical every year, which is free, right? So if you're paying a lot of money, you want to use it, right? And you don't really need to use healthcare at this point in your lives unless you are with a special need illness that you have maintenance or something like that that requires that. And even then, every healthcare plan covers those things. It's very, very rare that exclusions are made, okay? So healthcare, it's definitely something that when you're looking for a job, they should be offering a good option of plans, and they should cover a percentage of that. More high than low, but you never know. Yes?
I have a question about transferring from your parents' health insurance, for example, to your own.
Right.
If you are employed, are you still allowed to be on your parents' insurance?
Sure. I mean, it all depends. I mean, the Affordable Care Act has put in some provisions that allow parents to cover their children until they're 26, right? So if you end up getting a job, this is kind of the great thing. So you're in the 22, 23 time frame. You want to work at a place that's not going to pay you a lot because you want to do some things that no other time in your life do you normally get to do, right? So I have somebody who worked for me here at Georgetown who got her master's degree and decided she wanted to be a scuba diving instructor. Cool, stay on your parents' plan, right? So in that scenario, you get to stay on your parents' plan until you're 26, and at that point, you when you get employed, you can decline coverage because you have coverage elsewhere. When you get to 26 and you no longer are eligible, it's called a family event.
Okay.
So an event, there's a lot of names for it, but we use family event at Georgetown. And it's a legal term that the IRS allows us to allow people to elect coverage when they're losing it elsewhere. So you'll have lost coverage with your parents, the next month you get it with your employer. So, yeah, you're welcome. So healthcare, like I said, not riveting. It's only riveting when you have a scenario where you wish you had it and you're spending $30,000 for that hospital care for that ski accident you had in Vail. I've never been to Vail, so I don't know what that's like. But dental insurance is interesting. I'm going to be really honest about dental insurance. It's important to have dental insurance because what it does is it provides you access to a discount. Dental insurance is not robust like like healthcare insurance is. Dental insurance allows cleanings. It covers like $1,000 to $2,000 a year in any work that you might have done. The real magic there is when you're part of a dental plan, you're part of a discount that's been negotiated because you're part of a dental plan, and that $1,000 or $2,000 worth of coverage that you're paying for to have is really access to a discount. A crown that cost, you guys should not be in a scenario where you need crowns at this point in your life, but if in fact you are, $1,000 doesn't go far in that scenario, but a discount does. So it's important stuff like that. Have dental insurance. It's not ever very expensive. You need your cleanings every 6 months. I know all of you floss twice a day, and it's important because you all have great smiles. So dental insurance is definitely one of those things I call a dog in the the insurance industry, because it isn't robust like healthcare. Healthcare is intended to save you from the cost of incidents based on poor health or issues around health. Dental is really to help you maintain your teeth so you don't have to have those. There's a very big difference. But not having dental insurance, and I don't mean to sound like your parents, and my husband and I have 4 kids under 6, so I can't help myself at times, but not having your cleanings and not doing those things on a regular basis actually have a full scope effect on your health. They're tying a lot of connections between what happens in your mouth and the rest of your body. That feels like a no-brainer, and like everybody should know that, but for some reason it's just being proven. Life insurance. If you're going to be given life insurance, most likely at your employer. At 22 to 24, you do not need to buy life insurance because you really don't have anything in your life right now to really cover for anybody else, right? You don't have kids yet. You don't have I'm assuming you don't have kids yet. You don't have houses usually. You don't have a lot of things to cover for other people, but most employers give you a common life insurance coverage, which comes at free of cost. Like we give $20,000 to every employee of coverage. If you'd like to buy what's called supplemental life, you get to buy it in increments of whatever the company is offering you. And I think if you feel comfortable doing that, great. I think at this point in your trajectory, life insurance isn't the most important thing. Yes?
At what point would you recommend doing it? At what stage?
I started having life insurance when I was like 28, 30.
And what happened when you were 28 that made you do that?
I had a house.
Okay.
And I had events in my life. I had people that were dependent on me that weren't, even though they weren't my children. Like for example, I'll give you an example, a little TMI, okay? So, I know, 3 years ago, I had a partner, 0 kids, a lot of freedom. We ate out a lot. It was great, right? Then we adopted 2 kids. That kind of changed it. And then 8 months later, we got 2 more kids. So I already had a high life insurance coverage, but once I had 4 kids, I wanted the maximum coverage because if anything ever happened to me, I'd want to ensure that my husband and our 4 kids were covered. Like paying the house, doing whatever that is. Yes?
What happens if you were to die with your student loans, for example? Does that fall onto your family, even if you're not married? Like, where you go to your parents and anything like that ever happen, and that life insurance would be necessary for that?
Yeah, that's a really good question. Because my loans just got paid off like 5 years ago. So, I don't think that unless your parents are co-signers on your loans,
So there'd be no way that anyone could be held responsible for that if I were to die?
no. Unless you had an estate. Like if you had an estate for which that would happen, those that have estates score. Those that don't, I'm sorry, I don't have one. I don't think that life insurance in that scenario, but like that's the great example. If you had a very risky career path, like you were somebody who spent a lot of time in third world countries doing work in those arenas, and there was a risk of you passing, right? And your family members or friends were co-signers on your student loans or some form of a loan. And early on in our lives, we all have support. That's when life insurance is a great mechanism, right? They can be whoever you need to be can be the beneficiaries to ensure that those costs are covered, right? That was a fear of mine early on, and actually that didn't trigger for me until I had a house and I realized, oh, I have a house. Oh my God, my parents are co-signers on one of my loans I had from college. Oh my God. So I actually put together the right life insurance for me and have always had it. You should never buy life insurance outside of an employer at this point in your life. It's offered as part of your employment opportunity. The rates are based on a group plan, because individual life insurance policies are very expensive, and you should have your life insurance where possible through your workplace. And at your ages, your rates are low. So they're age banded usually, and your rates are low. So mine are actually, I hit 45 this year, my rates went up another like $140 a month, right? So you know, they change based on age. Yes? So you?
Since you're recommending that, since I guess we're young in age, we don't really need life insurance, when you're negotiating, is it common that young people decide to negotiate away life insurance for maybe higher health benefits or dental?
Yeah, so I'm going to talk about negotiating a little later. I don't have it like tied up here. But the one thing that people kind of don't recognize is insurances are group based. So I can't provide you no coverage and him coverage. So you can't say, you know, take out off my scorecard, take off life, because that's whatever dollars you might pay, I want that in salary. It doesn't work that way, because they're going to offer it, you accept it or not. It's a group plan. I think when we talk about compensation negotiation, which I think is probably a very key element right now, we'll get through that. But so in a scenario with life insurance, everybody's usually going to get a base life insurance. If you buy up, it's great. Disability insurance, which all of you think is not a big deal right now, I can tell it's riveting, like I said, and it's very important to you. So right now, if in a scenario, and I'll use Georgetown's example, if you have a disability illness which requires you to be out more than 15 days, up to 90 days, you want to have your salary, right? That's an important thing, because the minute that happens and you don't have your salary, you are caught in a situation where, you know, not only are you disabled and you don't have a salary and you have to deal with living somewhere and blah, 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 check, 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 right? And you need to pay your health care premium that you owe, right? That piece. All that really falls apart. This is a very important benefit to make sure you get at your employer. And I say that most employers give that, and it's not always as generous as one would think. So this is something to look in. For example, if you're at Georgetown and you have an illness that's going to be 90 days long, for that 90-day period, outside of a waiting period, which you use leave and stuff like that for, which for us is 15 days, we pay 100% of your salary for 90 days. And then after, say your illness continues on for maybe 4 months, that's actually too short of a frame, say 6 months long, so the first 90 days was at 100% of your salary as if you were still being employed at work. And after 90 days, you go into what's called long-term disability, means you're going to be out more than 90 days. Then we actually pay we give you 60% of your salary post-tax. So what that means is that, God, this is a complex, one of my stupid things that I have in my mind that I don't explain well. So most benefits are pre-tax. So I'm going to go backwards for a minute. You don't pay tax on your benefits usually, okay? The IRS allows you to pay for benefits through your employer at what's called a pre-tax basis. So that's great. So you reduce your income based on the cost of your benefits or your retirement that you put away in your 401k or 403b, which we'll talk about in a minute. All that stuff reduces your take-home income, which is fantastic because when you're filing taxes, you either want money back or you don't want to have to owe, right? One benefit that I think is very important to pay post-tax, and is usually the standard, is a long-term disability. And why I say that is that if in fact you get into a situation where you have a long-term disability and we're giving you, it felt it was boring too. You get into a scenario where you're in a situation with long-term disability, you in fact don't pay taxes on those dollars. So when I say that Georgetown gives employees that have been out more than 90 days in insurance for long-term disability at 60% of their normal take-home pay, you end up not paying tax on that 60%. So that means that 60% is almost equivalent to you getting 100% taxed. Because after taxes and deductions and retirement, people bring home between 60 to 70% of their salary as their take-home pay anyways. So in long-term disability, isn't it riveting? I can tell you're riveted. With your take-home, with your long-term disability, getting only 60% is not bad because you're actually almost making the same amount of money in LTD that you would being employed. That's when you pay it post-tax and you actually pay tax on it. Let me see if I can make this happen again. There we go. Okay, so disability is important. Make sure when you're looking at your job offer, they offer short-term and long-term disability, and you don't really get to choose what that is. It's what their plan is. They're not going to offer you options, and if they offer you options, it's because they're offering you to buy more than their standard. Usually, disability insurances are not something you have an option to pay for. We pay for short-term disability. We share the cost with you at Georgetown for long-term disability. So those are some things to think about. You get some options there, but make sure that you have disability insurance in your employer. And if you don't, and you're committed to working in the Congo, and this one organization wants you there, you can buy it in the marketplace. And if you buy it in the marketplace, you're going to come to me and I'm going to help you with that. Okay? Really, I'm really serious about this one. So retirement benefits, I'm going to take a few of these right out from the conversation. If you buy a savings bond, I'll hunt you down. Okay? And we're not going to talk about retiree medical benefits. I'm actually taking this off my presentation because saving bonds, I'm not letting you do it. Not that I have control of that, but I'm telling you, I'm not letting you do it. So retirement savings is very, very important. A 401k, which is the for-profit world, the 403b is the nonprofit world. They're the same vehicle. And what they basically are called is defined contribution plans and voluntary retirement plans. So a defined contribution plan is when somebody like Georgetown asks you, give us 3% and we'll give you 10. So you're putting 13% away. That's huge. So this is one at your age when you go out into the workforce and you're going to get a retirement plan option, you actually are going to put the minimum in to get the maximum benefit. And if you can put more in the minimum than more than just the minimum in, you should, and I'll talk about that in a minute. So defined contribution retirement plans really are unique based on organizations. They all usually have a match component to them. They are never as rich as they are in the academy. So most universities have a very similar algorithm to us. So you walk into Georgetown the 31st of December and you start on the 1st, and we give you 5% of your salary for showing up. I call it a show-up benefit. My actuaries and all my little advisors say, I can't believe you call it a show-up benefit, but in fact, you show up, you get 5%. Boom, bingo, right? Say you're making $100,000 a year, that's $5,000 a year we give you. Untaxed, it's yours the minute you get it every month you get paid, they give you 5% of that. For 3% more, Candace, right? You're kind of new here?
Yep.
Okay, so she's contributing to this, I can tell. And if she's not, she's going to run back to her office and sign up immediately, if not sooner. So for another 3%, I give you another 5%, because I want you to have some more skin in the game, right? So for 3%, I give you 5%. So that's 13% of your annual income. And if it's $100,000, that's $13,000 a year you get. 3% is yours, and that 3% that you're contributing to get the match is tax-free. So the IRS has limits in how much you can put in pre-tax. You're allowed to do up to $18,000 a year pre-tax of your dollars. So at Georgetown, if you make $100,000 and you are given 3%, that's $3,000. You can put $15,000 more away a year pre-tax. And I know that's a lot of money. That's a lot of money, right? That's $18,000 a year out of whatever salary you're making. I don't expect any of you to leave Georgetown and do that immediately. And if all of you, any of you do that, you need to call me because I'm taking you to dinner, because had I done that, I wouldn't be standing here today. I'd be enjoying retirement early. So it's hard to do, but once you get in that mode of doing it, it's very important. So the difference is you have a defined contribution retirement plan, which is the three, you have the 5% going into it. Our model is 5%, 3, and another 5. That's called defined contribution. And anything above that, are you riveted too? And it's riveting, isn't it? Can you believe I do this every day of my life? 3% of those dollars and that other 10% go into what's called defined contribution, because there's an algorithm for which is created to have those monies given to you. It's defined contribution. Then there's voluntary contribution, which is that remainder of those $18,000 a year you're able to put away. You voluntarily are putting those into a plan to be able to have them pre-tax as well. So those are the two options you're going to get. Another option you're going to get, I'll get your question in a minute. Another option you're going to get in the retirement schema, if you go for-profit organizations, is either profit sharing, which is another vehicle of giving you money, or stock options, which are paper until they're real, right? And that means you have to vest in them and you have to do all these other things, which I haven't. When I was at Gap, I always tell this story. So I was the head of HR administration at Gap in the late 1990s. Some of you weren't around yet, or just around. And I was given $675,000 worth of stock options. They weren't, you have to vest and all that stuff. So I actually got to a point where I was vesting, and then I was leaving to go to work at Stanford, and I thought, wow, I have all this money, right? Well, the market had changed, and if I had wanted those stock options, I would have had to pay the Gap $4,000. I chose not to do that. Maybe not a wise decision, because $4,000 then would have been a huge increase now had they got spiked back up, and they did. But they're just paper. So you can't depend on stock options as something that you're going to actually get until you get them and you can actually exercise them. What's your question on retirement?
You talk a lot about pre-tax and just done.
No, you're not.
Can you kind of explain, I guess, what that means
Yep.
pre-tax when you say retirement savings plan?
Okay, so what happens? So in a $100,000 scenario, oh my God, this is nirvana. I get to actually use a chalkboard. $100,000, okay? So if this is your taxable income, okay? And usually you have things that allow you to take away from your taxable income that the IRS allows you to do as an employer and as an employee. So for example, if you pay $200 a month for health insurance, you actually get those pre-tax, which means they reduce your taxable income because you don't have to pay tax on them. Okay, so this is your income. You minus $2,400 because that's how much you paid pre-tax. This reduced your income. Now you do another. Say you put away 3% of your dollars, 3% of your income into the retirement savings plan, the defined contribution retirement plan I'm talking about. $3,000, right? That's not taxable because you're putting it away in a tax deferred vehicle that allows you to pay tax on it when you take it out, which won't happen until you're 59. Then say you are at, if any of you start out with this salary, I kind of hope to God that you'll put the $18,000 away a year, because you'll never know you were doing it. You never receive that type of money in the first place. And if you're making $1,000 a year, $100,000 a year leaving Georgetown, I want to know what you did. Phone call later on, okay? It took me a really long time. And then, say you put $15,000 into the voluntary retirement plan. These dollars minus this is your taxable income. So that means you're paying tax on a much smaller amount of money than this. That's pre-tax. Post-tax is when you've actually used tax dollars that you paid tax on to pay for something, which is what I was talking about earlier when I was talking about the long-term disability. If you pay that by taxable dollars, When you receive that benefit, you can't be taxed on it. Okay? This is very important and people don't understand this. Yes?
So if you move from job to job, does your 401k stay with you to pay now, or does it change?
It changes. So when each employer offers you a plan, right? So I'll use, in my arena in the academic world, there's 3 big ones. There's Fidelity, Vanguard, and TIAA-CREF. So say you have a defined contribution plan at Georgetown and you have Fidelity. We have 3 options. And you're here for 5 years and you have all this money there. Usually, you can leave an employer and just keep the money there because it's in a plan that's yours, but the framework of like investment options are governed by the school, but they don't have any impact. They don't own your money, it's yours. Or you can move to, say you move to UNICEF and they have a 403B as well. You can transfer those monies from Georgetown to UNICEF and continue to have them grow there in that plan. So you can have, like I retire people every day, right? And I have faculty that have been here for maybe 20 years but spent like 15 of their years hopping around, finishing off research or completing their PhDs and being paid at that time and whatnot. Some of them have them everywhere and kind of like that diversity. Some of them have them all in one place. It's all a preference. I actually think managing it is easier having it in one place because you can control where its dollars go. That leads me into something else I want to talk about when it comes to retirement plans. At your age, you're allowed to be risky in your retirement investing. You usually will be given an opportunity to invest your dollars in a myriad of options. And I'm actually somebody who doesn't like to worry about that stuff, awkwardly enough, for myself. So I do what's called lifestyle plans. And they're basically pinned to an age of 65. And so if you're 22 and you're not retiring until 65, they're actually allowing you a lot of risk today. So they're really volatile. Your kind of monies go up and down like the stock market does, and it's kind of scary. But that's kind of the life cycle of how monies grow in retirement. And it's very important to allow that to happen, because if you don't take advantage of the highs and the lows, you miss out on the full opportunity of the 14% growth over the lifetime of an investment, okay? So, for example, I remember in 2008, I had my money's all at Georgetown. The retirement analyst that works for me who manages this piece of our business, our money's all dropped, and I said, I'm pulling my monies and I'm putting them in a mutual fund. And he looked at me like I had lost my marbles. I see how many of you in the business school, or how many of you have studied finance and investing? Anybody? Anyone? Okay. So you know that when your dollars drop, you're actually buying investments at the cheapest possible scenario. Well, I was ready. I walked in, I said, move my money, and he looked a little animated, right? You could, just by seeing me up here, you can imagine that I walked in and I went, Vivek, now, today I want it out. And he looked at me and he's like, what are you talking about? You're going to be able to, every dollar you put in today is buying investments at the lowest cost. So when the market spikes, you'll have more investment opportunity for growth. It's called riding the wave. I'm not asking you to be dramatically risky, but realize that your age, you're allowed to be risky in the market because you go up and down. And you always have investment tools available to you in your employers and in those plans that will help you with that. So this is I'm glad you brought this up as well, because this is a big deal. Like at your point in your lives and your income spectrum, it's important to know that you pay tax on the least amount of salary that you can. And if you're able to, I mean, really, honestly, I was told this when I was 20. I never listened. And I finally figured it out later. They used to say, if you put $1,000 away a year from the age of 22 to 32, and you just let it ride, you're done. I'm not sure that still applies, but I think that model of putting monies away that you normally wouldn't put away is important. Invest in a 403B or a 401k. Put the minimum in to get the maximum. And if you can put more than the minimum, put it in, because it's really going to benefit you. Sure.
Aside from the employer matching, if it's just tax deferred, what's the benefit of doing it pre-tax instead of just taking it out and putting it in a savings account for retirement?
Well, there's
different amount of tax you're going to pay on it when you're 60.
no. When you put money away post-tax, you only pay money on the gains. So to me, the interesting thing is, if this, we'll use these dollars here, right? So these dollars are retirement dollars, right? If you put these away, if you can't invest them in a post-tax scenario in your workplace, usually. They usually don't offer you that option, right?
Being like, I could get paid the $100,000 and then take $800,000 and put it in my Bank of America savings account.
You could.
What's the difference?
You could. First off, in a savings account, you wouldn't get the return.
Okay.
You want to put it in you could invest it right directly into the stock market, but you're not going to have the tools to do that, so you have to pay for it, advisement counselors. You have to do all that stuff, which you're not going to want to do, right? But if you move it and put it, having already paid tax, into a savings account, you're not benefiting from, how do I say this? So with these dollars, you've paid 25% tax on them, right? So if you've paid 25% and then put them away, you could not pay 25% and have that taxable piece of that income also be earning investment for you. So in this scenario, taking it after you've paid taxes on it, putting away, you're not getting the maximum potential for the least contribution. And it'd be better just to pay the income tax when you actually are using it as income, not in advance of that. Anything else? Any other questions on this? Yes.
Feel free to also defer this question, but when you were talking about it'd be great to put aside $1,000, and let's say that still works
Yep.
for our time. Given a lot of us do have student loans, is it still good to put away that $1,000 and then not be able to pay off the student loan as fast as you can?
I think it's a mixture, which is why in the world today, where you have a scenario where you can put away just 3% to get max of 10% of a contribution, this scenario allows you to put money away pre-tax and pay your student loans back. But also, student loans can be fairly cheap money. So I'm not like frankly, if student loans are fairly cheap money compared to other debt you might have, take the time to pay that out,
By
right?
cheap money, do you mean the interest rate?
Yeah. I don't know what the interest rates are for student loans now. What are they going for these days? Yeah. It does. So they're like six.
Grad plus loans are 8.6.
Okay. What are the undergraduate ones? Does anybody know?
It's like 4 something.
Yeah. I mean, those are kind of 4 is cheap money in my mind, right? Paying 6 or 8% might not be, right? But in that scenario, if you can do this and have something put away, and still be able to pay a little bit of that debt down and put a little money around, I think it's all about not buying Manola Blahniks when in fact, you could buy something else and still save money, right? I mean, I was not that bright, right? I paid more for clothes and eating out and stuff in my early 20s than I do today as an adult. So, as a full-fledged adult. So, it's all in your own behavior there. So the next thing that I think is kind of interesting, and it all depends on where you guys are going to go to work, is what I call specialized benefits. Parking, tuition assistance, company cars, gym memberships, and daycare. So, are any of you running into the daycare world right away? Good, I'm not going to talk about that. So these 4 are very important. Parking, if you're in New York and you need to use your car for a business, I doubt you want to pay $600 a month for parking, right? So that's a really great benefit. And that's something that you need to think about when you're negotiating, because these are things that aren't considered core benefits, right? Tuition assistance. How many of you, some of you are in graduate school here, but how many of you are going to go on to do advanced degrees? Okay? So I'm gonna put a plug in for Georgetown. If you actually come to work at Georgetown for a year, and you get into a program at Georgetown that you can do part-time, I will pay 100% of that. Just saying. You might want to think about it. Those of you that want to stay on the hilltop. But tuition assistance, as an example, is a very important benefit. It's important to actually go to, if you want to advance your education past your bachelor's degree, it's very important to look at opportunities where you can use a tuition assistance program to help you actually do that. Like when I was in Wells Fargo, I was also at St. Mary's College of California. At that time, they paid $4,000 a year. And when I was in college, that was nearly half my tuition. At Georgetown, if you work at Georgetown and you end up getting into a program, you can do an evening program or a part-time program, and you're working full-time at Georgetown, we'll pay 100% of it. Or if you're with us for 3 years, you're actually able to have a benefit to go elsewhere and get extended education. That's a very important one. So that's something, if that's something you're thinking about, that certainly can be something you can look into and can be negotiated separately. So that's not something, if they have a plan, great. If they don't have a plan, great. You know, when you're in a scenario where you're the rock star that they want leading their group in Congo to do whatever you're doing, and you're like, after I do this for 6 months, I want to be able to have the opportunity to go back to school and get some compensation for that, that's a discussion you get to have. And I also will say that it's very hard to heavily negotiate your first job offer, because it in fact is your first job offer, right? So unless you're the most amazing person in this most amazing field and you know how to negotiate that, I want to hear about that too. And you can do it, but it's also a struggle because there are a lot of people in the job market right now. So, company car. I have many friends that are in the sales arena. That's a very important thing to have as a company car. So that's something you can negotiate. If you know you're going to be on the road 4 or 5 times a week and you're going to be visiting clients and doing whatnot, do you really want to actually have them reimburse you for your mileage, which can be a really pain in the butt to send on these expense reports, or have them fund a car for you? Something to think about. And you know, another thing that I think is really important is the gym membership piece. And the gym membership piece is actually a small part of why I find that important. Although I'm not the total picture of wellness, I believe in wellness in the workplace, because the wellness in the workplace is holistic for your life. I hope and feel that the programming I do at Georgetown helps our faculty and staff have full lives in and outside of work. Not all employers think that way, but if they're offering a gym membership or discounted gyms or something on site or whatnot, there are 2 messages you need to read into that. They want you there a long time, which isn't bad, right? Most places want you there really working it. And number 2, they care enough to give you tools and other opportunities to keep yourself well.